These are our floor show traders, Tom Hayes, Phil Flynn. You guys have seen this forever. Tom, would you buy the risky stocks or would you buy the brokers now?
I would buy brokers and financials, Liz. Bank of America put out their global fund managers survey this morning, and the findings for $500 billion of assets under management, where they felt that 80% felt that tech was the most crowded trade in the multi-decade history of the survey. And they're trimming tech, they're trimming healthcare the last month, they're adding value, they're adding small caps, they're adding industrials. And that's consistent with 2021 earnings estimates. Industrials earnings growth are going to be 86%, financials 32%, S&P 26%. But tech is only going to grow at 13% next year. So a lot of their earnings power has been pulled forward this year. So if you're overweight in tech, you may want to start to diversify a little bit. We like financials. We like the major banks, Wells Fargo, Bank of America, JP Morgan. And like you said, some of the toll roads, we like Schwab. They bought TD Ameritrade. That will close the end of this year.
Yeah.
Now, with zero commission trading, they've got to make their money on the wealth management side, financial advisory side. And the other finding of the survey, Liz, is that managers expect when the vaccine comes out, yields will go up. That will help net interest margin for both the banks and the brokerage houses.
True. Right. Well, Phil, Tom makes a great point because people park their money. They use these brokerages in a way as banks, so that is certainly going to have a salubrious effect on them. But there's a lot of innovation. Fidelity, which is not publicly traded, is now doing stocks by the slice, probably a nod to Robin Hood. But tell me if you think that that's the way to go now. People should always be at least evaluating. I'm not necessarily reevaluating, but evaluating their portfolios after a long and protracted run-up like we've seen.
Yeah, there's no doubt about that. I mean, there is, the higher it goes, the harder it falls, right? That's the old saying. But, and I agree. I think you look at some of the stocks, if you're brand new to investing, you don't want to jump on the high flyer right away, maybe wait for a correction. You did have a pretty good correction in NASDAQ, so if you jumped on that, that was a good time. But you know what I love about this is that I love that the retail investors starting to realize that the stock market is a good investment for a lot of people. And it's not for everybody, we know that, but a lot of retail investors, I think, have been underserved in this market for a long time. A lot of people that haven't participated in the market that really should have the last couple of years is getting involved. So I think that's a real positive thing from this report. But as far as picking the brokerage, I think if I had to pick one, I would pick one that would be multifaceted, not just, focus on the retail end of it. Something like a Archer Daniels Midland, for example, that trades just about everything, supermarkets of the world, the physical and everything else. Because I know with the retail investment, it gets hot, it gets cold. Right now it's hot, but long term, I think we could see a bit of a pullback in the retail investment as well.
Yeah, sounds like it. NASDAQ still up 104, so those tech names powering the markets higher. Thanks to Tom and Phil.